But I also think it's a function of the monetary policy levers that the Fed is pulling, staying in, at least for now, this higher for longer. And that always has the effect of dampening demand. And that's why within inflation measures, if you look at CPI as an example, and you break out CPI into the discretionary components and the non-discretionary components, the discretionary components is actually that grouping is completely flat, almost verging on deflation territory, where the non-discretionary components are running at 6%. So we've seen interest rate sensitive segments of the economy. We've seen discretionary consumption be squeezed, but we're not really seeing it in those non discretionary kind of needs categories. And the rub there is that there's not a heck of a lot the Fed can do directly to impact things like auto insurance rates or healthcare costs. Unfortunately, to see serious disinflation there probably almost requires more deterioration in the labor market and or weakness in the economy that is more spread across the economy as opposed to what happened in 2022 when it was very targeted weakness in the economy. So I think it's a confluence of things. I also think consumption patterns, which obviously are a big driver of GDP, are also bifurcated in terms of what's going on up the income spectrum, where there's still excess savings, there isn't a big debt problem or default problem. Very different story when you go down the income spectrum.
On this episode of the What the Finance podcast, I have the pleasure of welcoming on Liz Ann Sonders. So Liz Ann is the Chief Investment Strategist at Charles Schwab Co. So Liz Ann, thanks so much for coming on the podcast today.
Oh, thanks for having me. Appreciate it.
No problem. I'm looking forward to the conversation. You have really interesting views, and I'm sure we'll touch on a lot of those throughout our conversation. So where I'd like to start is quite a general question that we sort of start with all of our guests. So what is your current outlook on, I guess, markets and the economy?
So on the economy, I think that, well, first of all, to say this is a unique cycle is the ultimate understatement. All that does is elicit duh. But I think there have been different aspects to the uniqueness, but a lot of it had to do with bifurcations that I think have really kicked back in earnest. So early on in the pandemic, when the stimulus era was upon us, that of course was at a time where everything was still shut down globally. So all of that stimulus and the demand associated with it was forced to be funneled into the goods side of the economy. That became the breeding ground of the inflation problem with which we're still dealing, but we subsequently rolled over in those categories within the economy: housing related, manufacturing, a lot of consumer oriented goods and products, and went into actual recessions there, sort of rolling recession idea. We went from hyperinflation to disinflation to deflation in the goods categories. We've just had, of course, the offsetting later strength in services. Services, a larger employer, helping to explain the resilience of the labor market. The services categories within inflation measures, particularly the shelter components, are just stickier by nature. So I think that's why we've been able to avoid a traditional, NBER defined recession, but we have had recession like weakness in pockets of the economy. Now everybody's focused now if and when the services sector falters, which that is probably tied to what happens in the labor market. I think the labor market has some cracks that are starting to show. I wouldn't pay a lot of attention to payrolls. It looks like they probably were overstated to the tune of about 800,000 payrolls last year. We won't get those benchmark revisions until the early part of next year, but economists are starting to suggest 60 to 70,000 per month of overstating, which means the more somber message from things like the household survey and hours worked, and then recently the pickup in claims does suggest that we're seeing some weakening in the labor market. Maybe not necessarily a bad thing in terms of a solution to what still ails us on the inflation side. So we've got these bifurcations. It was goods versus services. Now it's discretionary versus non-discretionary. There's bifurcations in terms of high income confidence versus low income confidence. And there's so many ways that that's manifested itself in market behavior too, not least being the heavy concentration into, let's call it the Fab Five right now, a subset of the Magnificent Seven, really at the expense of underperformance pretty much elsewhere across the board. So I think from a market perspective, there are two very different stories being told. One at the index level, driven by a small handful of mega cap names, and the story being told by the rest of the market, which is a little bit more reflective of some of these macro uncertainties. So that's the entire market and economy in a couple of minutes.
Yeah, the whirlwind tour of the economy and markets. But yeah, let's stick on the economy because I think that's something that's quite interesting. You say, generally we see, I guess, a overarching recession for the majority of the economy influenced by something. But as you said, there's these sort of little pockets. So is that just the fact that maybe the fiscal support coming in has been very targeted to certain industries? Maybe that's supported it, or Fed action. Do you any ideas on maybe why this is happening?
Yeah. So, initially the goods versus services bias toward goods was driven by the fact that services were shut down. So that wasn't really about where the stimulus was targeted. The stimulus was massive and pretty much to everybody, to every business. It's just there was constraints on access to services. So the funneling effect on the goods side. Now I think it's a function of a number of things. You're right on where certain fiscal stimuli has been targeted, whether it's the CHIPS Act or the Inflation Reduction Act, maybe poorly named. But I also think it's a function of the monetary policy levers that the Fed is pulling, staying in, at least for now, this higher for longer. And that always has the effect of dampening demand. And that's why within inflation measures, if you look at CPI as an example, and you break out CPI into the discretionary components and the non-discretionary components, the discretionary components is actually that grouping is completely flat, almost verging on deflation territory, where the non-discretionary components are running at 6%. So we've seen interest rate sensitive segments of the economy. We've seen discretionary consumption be squeezed, but we're not really seeing it in those non discretionary kind of needs categories. And the rub there is that there's not a heck of a lot the Fed can do directly to impact things like auto insurance rates or healthcare costs. Unfortunately, to see serious disinflation there probably almost requires more deterioration in the labor market and/or weakness in the economy that is more spread across the economy as opposed to what happened in 2022 when it was very targeted weakness in the economy. So I think it's a confluence of things. I also think consumption patterns, which obviously are a big driver of GDP, are also bifurcated in terms of what's going on up the income spectrum, where there's still excess savings, there isn't a big debt problem or default problem. Very different story when you go down the income spectrum.
Okay, great. That makes sense. So you mentioned there's sort of almost like a this K economy, I think, and it's something that sort of keeps coming. It's the I guess unfortunately, the really strong parts of the economy are doing well. This is a good thing, are doing great, but the other parts are struggling. I guess that's the same for people and basically every part of society as well. So,
Yep.
yeah, is this just the nature of what's been happening, or is this sort of similar to what you've been saying already?
Um, I think that the angst being felt in large part by consumers and picked up in monthly metrics like University of Michigan's consumer sentiment is a function of inflation, but maybe not inflation the way we as market watchers and quantitative analysts we're in the weeds of headline PCE versus core PCE services X housing, the month over month readings, and how that tracks to the year over year readings relative to where the Fed is. You can do the same thing with CPI or PPI. The reality is that inflation is felt in level terms by the average consumer, and it's driven by pre-pandemic, post-pandemic mindset of don't tell me about the month over month changes and that we've got disinflation. All I know is I'm still paying more than I was for, fill in the blank back to 2019. And I think that angst about inflation has filtered into things like consumer sentiment, but also some of the recent survey data out there. I don't know if it was a Gallup survey or a Harris survey. It was a shockingly large percentage of people that think we're in a recession, that unemployment's at a 50-year high, that we're still at all-time highs in terms of inflation. And it just has to do with with the psyche, which doesn't always track with the numbers and the data that as market analysts and economic analysts we're in the weeds of on a day-to-day basis. So I think that helps to explain not only some of the bifurcations, but the seeming disconnect between what the data actually shows and how people feel.
Yeah, one thing I think, a lot of people are saying is that trends seem to be a lot more, a lot stronger maybe today than they were, I don't know, in the past. So we're seeing the stock market. We're also seeing, maybe political trends or even economic trends, or, once these things get into the forefront of the mind, it seems like they're sort of, it's hard to
And
change.
exacerbated by social media and confirmation bias and the sort of filter that happens that we end up sort of feeding our confirmation bias and getting news that is not broad and always data or fact based and but that's the nature of the modern era, and that's not changing anytime soon.
Exactly. It's just trying to find ways to manage it. So you mentioned there that I guess services, CPI seems to be at quite a high level, especially some of those things that you mentioned before, such as auto insurance and healthcare. But I guess they probably have been at a high level almost for the last, you could say maybe since China joined the WTO, and then since then we've seen inflation for products go down and then services is go up. So is it just the fact that maybe both of them have gone up at the same time, which is why it's really affecting people?
Yeah, I think that that's part of it, and I think there is hope on the. It's not so much services because a lot of people don't think of the shelter component as a service, but it's the non-goods, the non-commodities segments of inflation, and I am hopeful that we're going to see particularly those shelter components start to catch down to all of the real economy measures of things like rent inflation. You've got the 40% of the core CPI is owner's equivalent rent. And it's an imputed measure. It requires that individuals actually guess what that imputed rent would be by asking them, what could you get for your house if you were renting it out? I'm not sure how accurate that data set is, but it is what it is. The real economy rent metrics have already rolled over and are significantly lower than what you see if you look at those shelter components in traditional inflation measures. And even in areas like auto insurance, which has been the biggest gainer in terms of month over month, year over year inflation readings, the most recent CPI report, you actually, in month over month terms, finally dipped into negative territory. Now, that doesn't help the level problem, but maybe a step in the right direction. So I do think we are ultimately going to see disinflation kick in those areas where it's been stickier. But the other side of that is we may, in turn, if we start to get some relief on the services side of inflation, we could see another pickup again in the goods side of inflation, especially if the pickup in oil prices persists. That would clearly impact headline measures of inflation, but even core, ex food and energy, it can sometimes filter into those good categories. And it's just another example of sort of this roll through. We had roll through of economic weakness and strength in the economy, and we've had a roll through in terms of segments of inflation and places where it's been cold and other areas have been hot. And I think that type of backdrop is likely to continue. And it's frustrating. It's frustrating for market watchers. It's frustrating for consumers and businesses because there are so many cross currents in this very unique cycle.
Yeah, and do you think that's why maybe the Fed have been more hawkish? Last week we had the FOMC meeting, and they sort of reduced their expected cuts to one this year, and that was against the market's peak of six, I think, a few months ago. So, do you think they're also concerned about this? And I guess, do you think they're actually making the right decision?
Well, yeah, I think being in pause mode right now probably is the right decision. Whether it ultimately, with the benefit of hindsight, is looked back on as saying they were correct in being data dependent. Inherently, being data dependent, the Fed is making decisions based on backward looking data, and that, in theory anyway, argues for a higher chance of some sort of policy mistake. But I think what the Fed is really trying to do is avoid maybe the mistakes made in the 1970s under the Arthur Burns Fed, where you had two distinct periods where, after tightening policy because inflation had accelerated significantly, inflation came down. And instead of sort of taking the win and staying somewhat neutral, they opted to ease policy, having hung the victory banner on inflation, and in doing so, let the inflation cat out of the bag again. And that happened in a whole nother cycle, which is ultimately what led to the experience of the early 80s and Paul Volcker and having to jam interest rates up into the teens. And I think it's the fits and starts of monetary policy that the Fed wants to avoid. In addition, part of the reason why they reinforced a more hawkish stance was a few months ago, you had that string of much hotter than expected inflation readings. And I think rightly so, they wanted to express some caution in not cheering too loudly for 1 month's worth of better CPI readings, that they really are interested in seeing trends, not react to individual data points. So I think the mode that they're in right now of not doing anything probably makes sense. First of all, the market was way over its skis in January when it was pricing in a March start and 6 to 7 rate cuts. I mean, there was nothing in the data that suggested that was appropriate policy. Now I think there's a little more sort of realistic assumptions in terms of where they are and how close they are to moving to an easier stance.
Hey everyone, sorry for interrupting. I just wanted to extend a massive thank you to you for listening and tuning in, and for your support over these 3 years. So we've had, hundreds of guests that we've welcomed on the podcast. We've had millions of views with hundreds of thousands of different people listening in. So I just wanted to thank you. I started this as a student. I'm now currently working, and I've always done this on the side just because I have a passion for it and I've enjoyed it. And probably similar to yourself, you listen to all these, different YouTube channels and podcasts of people listening to different guests. That's how I started, and I just wanted to sort of take the plunge and be able to have the opportunity to speak to these people, and you've made that happen. So thank you very much. Just myself, don't make any money from this, and it's really a passion project. So thanks for supporting that passion of mine. If you wanted to support the channel, all I ask is if you could like, subscribe, or even comment, positive or negative feedback. I'm always willing to take constructive criticism. I'd really appreciate that. But otherwise, thanks so much. If you can believe it, only 14% of our listeners actually subscribe to the podcast. So yeah, if you can, great. If not, no problem at all. Thanks for listening, and yep, let's get back to the show. Yeah, okay, that makes sense. So, what do you think they have to see to maybe then be happy to cut? Is it the, disinflation? Is it employment numbers? Is it both?
It's probably both. Even if you look at core PCE, in which is their preferred measure, then you've got the subset of that, the super core, which is core services X housing. But let's just think in core PCE terms, because that is the stated preferred metric. You would have to have a string through the end of the year of flat to no more than zero point 0.1 on a month over month to get in PCE down to anything resembling the Fed's 2% target. Anything beyond that, you actually have the possibility that you're going to see it hook back up a little bit. And that's just the nature of the math associated with base effects, given that last year was a period where a year prior to that was the peak in inflation when CPI had a 9 handle on it. So that was a really, really high bar. It was easy to beat on the way down a year ago. Now we're taking a lot of those lower numbers out of the mix. So the math is a little bit tricky, which is why I think the labor market comes more into focus as the other part of their mandate. And I think if we were to see further deterioration witnessed in claims or job openings, maybe a combination thereof, something weaker on the employment front, not just payrolls, but all of the underlying readings that you get in the monthly jobs report, like the household survey, like hours worked. I think ultimately the Fed would be willing to point to weakness in the labor market absent a move down in inflation to justify moving to an easier policy stance. So that doesn't mean inflation's irrelevant. It just means that I think the Fed has at least an equivalent eye on the labor market as it does on these monthly inflation readings.
Okay, and yeah, it sounds like they don't trust payroll that much as as we see
No,
there.
no one should. No one should. Not that we shouldn't trust payroll, but here's a couple of caveats. One, the establishment survey, which the Bureau of Labor Statistics does, that generates payrolls, the response rate is down quite dramatically. Not quite sure why. Some of it may be pandemic related, but the response rate is down. That, in and of itself, has meant that revisions to prior months have been larger than normal relative to past cycles. In addition, it's often the case that when you're at an inflection point, you're in a downturn in the economy, even if you're ultimately landing softly and not going into a recession, the household survey tends to provide the more accurate read, in part because of the what is used in the establishment survey by the BLS, which is the birth death adjustment. That's the birth and death of businesses. And the BLS tends to overstate business births at this point in the cycle and understate business deaths, which is why with this quarterly census survey that is already out, um, economists are trying to map what that is likely to mean for the annual benchmark revisions that we don't get until the first quarter of next year, but it could be to the tune, as I said, of about 800,000 less jobs created last year than what was seen when just looking at the initial report on the part of the establishment survey. So I think that we have to understand the mechanics of these surveys, the differential between the surveys, and what you can infer based on where we are in the cycle. And it does suggest that the labor market is not quite as strong as what you would think if you just looked at the first read of payrolls, call it over the past year or so.
Yeah, I imagine that's a challenge of just the of the beast of the economy and trying to measure these massive things in a country of,
Yep.
300 plus million people. And it's all about what you measure. And sometimes
And
it's,
and
you
by the
name it.
way, I think the other thing too is the immigration piece of this, which has been significantly additive to labor force participation and has represented a pretty decent chunk of job creation has been by the non-native born, and trying to incorporate that into all the math on the labor force participation, how much of it is contributed to payrolls, and even broader, how much has it been to the benefit of the economy from both the supply side and the demand side, and becomes trickier even in an election year where that is such a hot button issue to get out of the sort of morass of the political sides and actually say, let's just look at the data. And it's not easy to incorporate and calculate, but the least we can do is try to actually look at the data and leave the blue versus red out of the mix. I would say the net is that in terms of things like labor force participation, the supply side of the economy, the demand side of the economy, immigration has been a net positive.
Yeah, I know everyone's starting to talk about the GDP per capita. That's a big one in Canada and
Yep.
Australia and probably the US as well, where it's a positive. But then I guess, you know, yeah, is it going to continue in that way?
And I'm glad you said that on per capita, because another thing that needs to be thought of as it relates to things like immigration is that per capita calculation. So one for instance there would be total consumption, consumer spending in the United States in last year in 2023, the full year was about $19 trillion. That's a record high, but that's not population adjusted. It's also a nominal reading, it's not a real reading. You look at either the real consumption data or you look at per capita, and it's more kind of in a flat line since about 2021, 2022. So that's another sort of word of caution in this environment of still high inflation. And when trying to take into consideration the effects of immigration, make sure you're not just focusing on nominal, you're also looking at real, that's the inflation side of things, and try to get the data per capita population adjusted using some reasonable assumption of non native born.
Yeah, and I guess it's the same where it's, per item basis. I think consumption's gone down, but because of the price of those
Right.
items have
That's
gone
right.
up, so people are, yeah, overall consuming less. It's interesting, these intricacies. So yeah, if we look at the markets, I guess we talked about before. What do you think this means? Do you think it's just going to be a continuation of what we're currently seeing, or yeah, do you see any shifts in that?
So, you know, two people, let's say there were two strategists at the beginning of this year, and they were having a debate over what the market was going to do in the first half of the year. And strategist one said, I think the market's going to rip and we're going to see the market at all time highs. And the other strategist said, I think it could be really ugly and a lot of stocks could get hammered. They would both be right because it's a function of whether you're looking at the index level or you're going more granular and looking at the average stock or the median stock and data that is important to put this in context and to understand it would be things like maximum drawdown. So I'm going to use the Nasdaq as an example. It's the more extreme example relative to the S&P, but it's illustrative. So the Nasdaq so far this year, its maximum drawdown at the index level. So the worst amount of pain from a peak to a trough year to date, call it the first half of the year, is only 7%. But the average member maximum drawdown within the Nasdaq year to date again is 37%. That's deep bear market territory. It's just happened via a process of rotation and corrections under the surface and churn. And because you've had such dominant performance by four or five stocks, that has kept the index afloat. But I guess the real story or a fuller story is being told under the surface. Now it's not as extreme for an index like the S&P, but it's still somewhat glaring. The S&P has had no more than a 5% maximum drawdown this year at the index level, trading at all-time highs, but the average member within the S&P is down 15% in terms of maximum drawdown. In addition, if you look at sort of the other stocks aside from the, Fab 4 or Fab 5 or Mag 7, whatever categorization you want to use, you have a very low share that are outperforming the index. So even if you capture all the names in the S&P 500 inclusive of the high flyers, in the past year only 6% of the S&P components have outperformed the index itself over the past year. It's only 16% over the past month. The highest you get to within a year time frame is the past 3 months, but it's still only 22% of the S&P has outperformed in the past 3 months. Now, having concentration where a few high flyers are dominating performance of a cap weighted index, that's not terribly abnormal. The risk becomes elevated if the rest of the index is significantly underperforming. So you have it sort of in both directions, and that to some degree is what's happening now. It is a risk. I think it's a meaningful risk. The problem is pinpointing the timing of when you start to see some convergence. And I would be no better at trying to do that than anybody else. This concentration problem could get a lot worse before it improves in whatever form.
Do you think this is a maybe because we've seen ZERP for so long? Is this just the fact that a lot of these business models don't work in a high interest rate environment, or is it maybe something different?
So I think in terms of why the winners have been winners, it's a combination of factors. One of them does relate to interest rate sensitivity and the fact that many companies termed out their debt, and that was biased more up the size spectrum, such that a lot of the big dominant drivers of the market, which also happen to be beneficiaries of the AI boom, so add that into the mix, are also giant cash generators or cash rich companies with strong balance sheets. They, in many cases, earn more interest on their cash than they pay interest on their debt. Even in the aggregate for US companies, we're at an 18-year low in terms of net interest payments. Of course, the problem starts to become more meaningful in terms of interest rate sensitivity as you go down the cap spectrum and you go into, say, small cap indexes like the Russell 2000, where about 40% of that index still today are some combination of zombie companies, meaning they don't earn sufficient cash flow to pay interest on their debt, let alone, fund operations on an ongoing basis, and or not profitable, negative earnings companies. And that is where you've also seen big performance spreads. So too often I think people look at market averages, or they think that if they're asking questions about large cap versus small cap, they'll say, well, Liz Ann, what do you think of small caps? Well, that's a giant index, regardless of what index of small caps you're looking at. You can't be monolithic when analyzing this. And an example of that is within the Russell 2000, going back to the beginning of 2023, the zombie companies within the Russell 2000, their stocks are down 10%, yet the non-zombie companies, just using that as the qualifier, are up 10%. So a 20 percentage point difference. So you can't generalize in terms of how an index like that is doing, but where you can sort of find an edge in terms of where to look for opportunities outside just the mega cap high flyers is you want to stay up in quality. You want to look for profitability. You want to look for strong balance sheet and strong free cash flow and high interest coverage. And that's, I think, the way to navigate where the minefields have been and where there has indeed been sensitivity to the most aggressive tightening cycle in 40 years. You just don't pick up that interest rate sensitivity if you're only focused on the cap weighted indexes and where they're trading.
Yeah, that makes a lot of sense. So I know it's hard to predict, but I guess if we look at the economy, where do you think it looks like we're sort of going to continue just the way we're going at the moment? Do you see any changes to what we're currently seeing?
So, as I said, there are cracks in the labor market, as witnessed by the big spread between the establishment survey and the household survey. I think the last couple of weeks of a pickup in initial unemployment claims, in addition, continuing claims. It's people who continue to stay on unemployment insurance. Those are incredibly important to watch right now because I think there are ripple effects or feeder effects from the labor market into pretty much every other measure of the economy through sort of the confidence channel. There is still some excess savings, at least up the income spectrum. Wage growth is still fairly decent. So, right now, the consumption side of the economy is in okay shape. But I think that's been very much supported by confidence in the labor market. And if we were to see some deterioration there, I think it would be felt fairly quickly in other measures of the economy, not just in those specific labor market metrics. So, to some degree, the Fed would like to see maybe. Here's a way I think about how the Fed looks at the labor market. The Fed is not trying to engineer a big move up in the unemployment rate. They're not trying to crush jobs. They're just trying to add some looseness into the labor market, sort of crush job openings without crushing jobs. It's a pretty narrow opening in the needle that they're trying to thread. But if the labor market can hang in there, then I think the economy could continue to just sort of turn along here with different pockets of strength and weakness at different times. But I think if we start to lose that footing of the labor market, I think the feeder into broader components of the economy, not least being consumption, would probably be felt fairly quickly.
Okay, that makes sense. And something that we haven't touched on is sort of QT. Do you see them, I guess, continuing in the trajectory that they're going, or do you think that might be the first mover in before rates? How do you sort of watch that?
My guess is they'll make a more definitive decision on rates before they make any change to the process right now on the QT side of things. That's essentially what the Fed has been telegraphing. They're not telegraphing timing of rate cuts because they don't know themselves, being data dependent, but they have been telegraphing that that's their bias is to move on rates, and that they certainly hope the next move is a cut, and they expect it to be a cut. They're just not being precise on timing, but I would expect to see the move first on the rate side of things before the balance sheet side of things.
Perfect. So, Liz Ann, thanks so much for your time today. Really appreciate
My
it.
pleasure. Thanks for having me.
Yeah, no problem. And just one more question. So, what is
Yeah.
one message you like people to take away from our conversation?
Notice I didn't try to do any market forecasting. I think that's a fool's errand. And I always say to audiences of investors that it's not what you know or I know or any other strategist or pontificator knows, meaning about what the market is going to do. That's not what matters because no one has the answer to that question. What matters is what we do along the way. Too many investors focus on moments in time, on trying to pick tops and bottoms, making all or nothing decisions, get in, get out, whether it's of the market overall or certain segments of stocks like the, Fab 4 or 5, or maybe the, the Marvelous One. There are disciplines that can be done in a less extreme way. I always say neither get in nor get out is an investing strategy. That's just gambling on two moments in time. And investing should be a disciplined process over time. So the subtleties of diversification across and within asset classes, the beautiful discipline that is rebalancing, which forces us to add low and trim high, a version of buy low, sell high without having to make all or nothing decisions. So that's ultimately what matters more than all the stuff, frankly, that we've talked about for the last half hour.
Perfect. Great message to leave with then. So yeah, thanks so much again for coming
My
on. If
pleasure.
anyone wanted to find out more about your work and what you do, where would the best places for that be?
Well, so all of our research is on schwab.com on the public site. You don't have to be a client, you don't have to have a login. There's a learn tab. That's where all the research is. I'm on X, or formerly known as Twitter. I have a rash of imposters, and they're not only on X. Make sure you're following me. Look for the blue check mark. I have about 420,000 followers. So if you see somebody with some weird spelling of my name that has 16 followers, I assure you that's not me. I've had an even more troubling rash of paid ads and imposter accounts on Instagram and Facebook. None of them are me. I do not have a stock picking club where I guarantee returns in the three stocks that I'm going to privately tell you about. Those are all scams. Those are all imposters. There have been as many as 250 of them a day. And we keep playing whack a mole trying to get them to be taken down. And I'm also on LinkedIn. So the only two social media channels I'm on and I'm active on, make sure it's me though, is X and LinkedIn. So don't get duped.
It's crazy
It is crazy.
how quick they are. But yeah, I'll put that on the description below so everyone can access them through those links. But thanks again for your time.
My pleasure.